Hey everyone, welcome back to Financial Market Insights for Traders, the podcast where we help you decode the markets, grow your confidence, and build financial strategies that work no matter where we are in the economic cycle. I'm your host, Sophia, and today we're diving deep into a big topic on every smart investor's radar right now: recession-proof investing strategies. Because let's face it, when the economy slows down, fear spreads fast. Headlines scream recession, portfolios bleed, and panic selling hits a new high. But here's the truth: downturns aren't the end. They're not financial death sentences. In fact, they can be huge opportunities if you're prepared. So, let's break down 10 actionable steps you can take to protect your portfolio, stay calm, and even profit when markets start to stumble. This is not about timing the market. It's about having a game plan that works. Let's get into it. Step 1. Understand what happens in a recession. Before we talk strategy, let's define the battlefield. A recession is when GDP falls for 2 consecutive quarters or more. But it's not just numbers on a chart. Recessions come with a set of very real ripple effects: rising unemployment, shrinking corporate profits, consumers spending less, businesses tightening up, and a surge in market volatility. The stock market becomes ultra-sensitive. News cycles become chaotic, credit tightens, consumer confidence dives, and investors either panic or pivot. Our goal: be the ones who pivot. Step 2. Embrace diversification. Diversification is your financial seatbelt. When everything gets shaky, you don't want all your chips on the same number. Here's why it matters. Some sectors tank, others hold steady. International markets may recover faster or be less affected. Bonds and gold? They often rise when equities fall. Here's how you do it. Use ETFs to get exposure to entire sectors or global regions. Add real estate or REITs to tap into income-generating property. Always keep a chunk in cash or equivalents for flexibility. And please, don't over-concentrate in one hot asset class. That's a fast track to disaster. Step 3. Focus on defensive sectors. When times are tough, people don't stop buying essentials. That's why defensive sectors should be your best friends during a downturn. Some of the best stocks during a recession are in healthcare. People still need prescriptions, medical care, and insurance. Utilities, electricity, water, gas. We can't live without them. Consumer staples, think food, toilet paper, soap. Needs, not wants. Steer clear of sectors like luxury goods, high-end retail, and travel. They're often the first to get cut from household budgets. Step 4. Favor high-quality, dividend-paying stocks. Recessions separate winners from losers. In times like these, bet on companies with low debt, healthy margins, consistent cash flow, a track record of surviving downturns, and those juicy dividend payers. They do double duty. They not only signal financial health, but they also provide you with income even when prices drop. Look into dividend aristocrats, those rock-solid companies that have raised dividends for 25 plus years. They're often considered safe investments in 2025 and beyond. Step 5. Increase bond allocation, but be smart about it. When stocks fall, bonds can rise. They provide income and reduce your portfolio's volatility. Some solid options include U.S. Treasuries, ultra-safe and backed by the government; investment-grade corporate bonds, higher yield with reasonable risk; municipal bonds, great for tax-conscious investors. Stay away from junk bonds. Recessions raise default risks, and those high yields come with strings attached. Step 6. Keep some cash ready. Cash isn't sexy, but it's powerful. It gives you options. It protects you from having to sell at a loss. And it lets you scoop up bargains when others are forced to sell. A good rule of thumb: keep 5 to 15% in cash or short-term cash equivalents like money market funds or treasury bills. That liquidity is your lifeline. Step 7. Dollar cost averaging. Trying to time the bottom of a recession is like trying to catch a falling knife. Instead, go with dollar cost averaging. How it works: you invest a fixed amount on a regular schedule. When prices drop, you buy more. When prices rise, you buy less. Over time, This smooths out your entry points and keeps your emotions out of the equation. Simple, smart, and effective. Step 8. Don't ignore alternative assets. Traditional assets don't always give you the protection you need. That's where alternative assets come in. Consider diversifying into gold or silver, traditional safe havens, commodities, energy, agriculture, depending on global trends, crypto, not for the faint of heart, but small allocations can hedge inflation, private equity or peer-to-peer lending, illiquid, but often produce strong returns. These add an extra layer of resilience, but make sure you understand the risks. Step 9. Avoid emotional decisions. This might be the most important point of all. The worst investing decisions are made in panic. Big mistakes to avoid. Panic selling after a drop. Trying to time the rebound. Chasing safe stocks after they've already spiked. Stick to your plan. Rebalance your portfolio periodically. Make decisions based on logic, not headlines. Corrections are temporary. Your discipline shouldn't be. Step 10. Use the right tools and stay informed. Your platform matters. Your knowledge matters more. That's why I highly recommend using a world-class trading app like crystalballmarkets.com. It offers cutting-edge tools, a user-friendly interface, and everything you need to trade with clarity, even during volatile times. And if you want to stay sharp, you need to be learning constantly. That's where the Crystal Ball Markets podcast comes in. It's designed for beginners and experienced traders alike, with easy-to-understand insights on trading, investing, macroeconomic trends, and more. Check it out at our ss.com/podcast/crystalballmarkets. It's a great way to upgrade your financial IQ while you're commuting, working out, or just relaxing at home. Final thoughts. Prepare, don't panic. Let's wrap this up. You can't control the economy, but you can control your reaction to it. The difference between surviving and thriving in a recession is preparation. Diversify smartly. Stick with quality. Keep some cash handy. Don't let fear run the show. Recessions are temporary, but your financial habits? Those last. Make them count. So if you're serious about recession-proofing your strategy, here's what to do next. Visit crystalballmarkets.com/platform to explore a powerful, intuitive trading platform that's built for volatile markets. Subscribe to the Crystal Ball Markets podcast at our ss.com/podcast/Crystal Ball Markets to stay ahead of the curve. That's it for today's episode of Financial Market Insights for Traders. I'm Sophia, reminding you to stay focused, stay flexible, and always invest with intention. Until next time, stay smart, stay steady, and keep your eyes on the market. Outro music playing.